God, how long has it been since we met? It was like a month ago. It
Give or
was
take. Yep.
when we were in Newport Beach.
Right.
It's been a month. Well, I guess there's been as always a few market changes. What are you seeing out there, Rick?
Well, it's interesting. We've seen a little bit of an increase in prices in a lot of markets across the country. National Association of Realtors reported that last month, 7 out of 10 markets across the country saw price increases, and that probably runs counter to what a lot of people expected this year because of affordability issues that were really exacerbated due to interest rates going up. So the demand is there. It continues to be there. Demographically speaking, we still have the largest cohort of young adults between the ages of 25 and 34. First time home buyer age on average is about 33, and that cohort really won't peak numerically until sometime next year. So as properties come to market, we're continuing to see a lot of interest in those properties by prospective home buyers.
Now, those markets where the prices you've seen tick up, what generally is the sort of bandwidth of those prices? Is it all like Fannie Freddie eligible homes? What's it like?
That's a really good question. The bulk of homes we're seeing sold right now are within that conforming loan limit. That's for sure. And those types of loans still tend to be readily available for qualified borrowers. Unsurprisingly, a lot of the markets where we're seeing prices go up are in the Southeast, the South, some parts of the Midwest, but coastal California, for example, still suffering a little bit, Pacific Northwest. Some of the markets that really had prices accelerate outrageously during the early stages of the pandemic, the Boise, Idaho's, and St. George, Utah, and Phoenix, and Austin, we're actually seeing property values come down a little bit in terms of home prices. So it tends to be markets that were a little bit less expensive to begin with. You have people moving out of high cost, high tax states into more affordable places, and they're willing to spend a little more than current market calls for because they're moving into a more affordable area.
Interesting. How are days on market looking around the U.S. and different geographies? I'm especially curious as to days on market in some of those areas where some of the numbers are ticking up.
I'm smiling, Jeff, only because these are some of the fun things you can do with statistics. You remember that Mark Twain famously said there are lies, damned lies in statistics. And so you're looking at days on market, going up by 130% year over year. So now we're all the way up to about 24 days on market on average, which historically speaking is an instant sale. So that really hasn't shifted much in a material way. There's not a huge difference in most markets across the country. I've probably looked at 7 or 8 states. And you're talking a matter of days difference in terms of days on market. So it's really not that big a deal. So if a property is priced reasonably and more or less correctly, when it's put on the market, it's still moving pretty quickly. One of the things that's a little interesting for your audience specifically, and in the RCN capital world, is that it's taking longer for a flipper to bring a property to market than it has in recent years. So the most recent data I saw, which I believe was from the first quarter of this year, was that it was taking about 165 days on average for a flipper to bring a property to market. And that was up between 15 and 20 days from the prior quarter. So that's somewhat interesting. I don't know if that's due to supply chain issues, due to a lack of labor, due to prices, perhaps not being in tune with what we're seeing elsewhere in the market. But it was an interesting data point, I thought, nonetheless.
Yeah, it is interesting. Anecdotally, what we've seen here at RCN is folks that bought as rates were experiencing the most rapid iterations, right? So we're talking about January, February, March, of last year. Anyone that was buying in that time frame, even into April or May, those were especially the folks looking for bridge financing, who are going to buy, renovate, and sell into the marketplace. Those are the investors that we have found are having the most trouble, because typically they were overpaying for what they were buying, and secondarily they were underestimating, and I'd love to hear your take on this. They were underestimating the time that home was going to take to sell. And that's really what has caught them sort of flat-footed.
Yeah, I think you're spot on there, Jeff. The folks that bought really pretty much in the second quarter of last year really timed the market pretty badly, and it was nothing they could have anticipated. So these investors weren't bright people. I know some people that have been investing in fix and flip properties for decades and doing so very successfully, that got caught in that cycle. So you saw interest rates double in the matter of a couple months. Freddie Mac tells us that mortgage rates have never doubled in a calendar year ever in the history of the country until they did last year. So there was really no way to predict that. And they also bought at what turned out to be the peak of the market. So your financing costs are effectively doubling, and you're buying at a point in time where you just paid the top dollar for the property. Even if you were buying at a discount as an investor, you were still buying at the top of that cycle. And so in order to try and make a profit, you're probably going to list the property for more than what you're really going to be able to get. And the other part you have to factor in there, of course, is that you're going to sell that property generally to a consumer, a home buyer, whose affordability has just been cut in half because mortgage rates doubled. So really, really difficult timing. And I know a lot of investors took a bath on some of those properties. And it probably is one of the reasons that we saw fix and flip purchase activity slow down over the second half of the year, and very likely into the first half of this year as well, as investors are taking a much more cautious approach to coming to market and recognizing that the buyer pool for properties is not as robust as it might have been a year ago.
Yeah, the flippers and the investors that bought in that time and decided that they were just going to take it on the chin, we have found that those investors have actually been the most successful, not from that transaction, but what it's allowed them to do is recapitalize and get back into the marketplace calendar year 2022 late, right? Quarter four, November, December, and then January, February of this year, when the market had really started to find a bottom, and now they're back in the game. And as you mentioned, we're starting to see some housing numbers, at least on the listing side, coming up. And those investors that bought into that market now are starting to see, okay, there is money to be made here.
Yeah, they still need to sharpen their pencils. This is really not a good time to overestimate the value of a property, because who knows what interest rates are going to do over the coming months, and you have to be really careful about your estimated repair costs and your holding times, because that has to do with your finance costs. But market conditions are a little bit better now than they were 6 months ago, for sure. The mortgage rates don't seem to be something that an investor would necessarily look at immediately, but again, you have to remember who your ultimate customer is going to be. And so when those interest rates doubled a year ago, it meant that the average monthly mortgage payment on the same property would have gone up between 45 and 50% a month during that period of time. And that just knocked a lot of prospective home buyers out of the market. There's also not a lot of distressed inventory for investors to take advantage of. The most recent report that came out from Adam Data just a week ago showed that in April, foreclosure activity actually dipped a little bit from where it was in March. And we're in a market now where foreclosure activity is still only running at about 60% of where it was prior to the pandemic. And a lot of those homeowners in foreclosure have positive equity. 93% of them have positive equity. And in many cases, quite a bit of equity. So they're tapping into that to sell the home rather than lose all that equity in a foreclosure sale. And again, that reduces the potential inventory for investors to buy these distressed properties at something of a discount. So even though market conditions are improving a bit, it's still really, really important for investors to do their homework, make sure they're not overpaying for a property or overestimating the resale value, and kind of hedging their bets a little bit as we work through these times.
So 93% of homeowners have positive equity.
Yeah.
What are some macro numbers on that if you've got them, and what does that look like overall?
Well, if you're really looking at macro, almost half of homeowners with a mortgage have a house that's worth at least twice what their mortgage is due. So if you have a $100,000 mortgage, you have a $200,000 property, basically. That's down a little bit from where it was the previous quarter, but still almost at a record level. We're all the way down from a record amount of $29 trillion of homeowner equity to about 28.5 trillion. So yeah, the sky is falling and we should all start to panic. But if you dig into the numbers a little bit further, you also find that we have very, very few borrowers who are underwater on their loans. So if you go back to 2008 through 2011, we peaked at about 33% of borrowers, all borrowers, being underwater on their loans, owing more on their loans than the properties are worth. And that's down probably to around 5% today, which is a more normal number. That number tends to be a little higher than people would expect because there are borrowers who buy houses with very low very low down payment loans. So an FHA loan with a 3.5% down payment, a VA loan with a 0% down payment. Even some Fannie and Freddie loans are available with a 3% down payment. So if you happen to be in a market cycle where property values go down even a little bit, and you started out with a loan with a 3% down payment, not a big surprise that you're going to be underwater for a little while. Over time, that tends to normalize. But Jeff, what I found most interesting in the equity numbers was just how strong the equity positions were for borrowers in foreclosure. If you looked at the last time I crunched the numbers, there were about 270,000 borrowers in foreclosure, which again is about half of what we'd normally expect to see. Of the 270,000, about 100,000, a little more than 100,000, had between 20 and 50% equity in their properties. And 20% is a threshold a lot of people set as being the minimum amount you can have to sell a property, pay off your debts, and walk away with a profit. But 100,000 people had more than 20% equity. Another 60,000 people had between 50 and 75% equity in their properties. And then another 25 to 30,000 people had more than 75% equity. So it's not that these people have just a little bit of equity in their properties, they have a lot of equity. And if you're in foreclosure and you're sitting with 75% equity, there's no excuse for ever losing that property to a foreclosure sale.
So when you look, and those are some really interesting numbers. So when you look at the overall pool of folks in foreclosure, because a lot of times we hear the headlines, right? Foreclosures are up 175%, but the baseline is so small from where we're going to, we're not even back to where we were in 2019. But even with that said, when you look inside those numbers and you start to look at the equity that is available to the homeowners that are in foreclosure, what are we left with from a pool that is actually considered distressed?
That's a really nuanced question. Well, it's actually a pretty complex question. I'll give you a nuanced answer. How's that? I mentioned that we're running at about 60% of pre-pandemic levels of foreclosure activity. But if you parse that a little bit, it tells a very interesting story. Foreclosure starts, the first notice a borrower gets that they're in foreclosure, are back to about 80% of pre-pandemic levels. So they're getting closer and closer to being where we were back in 2019. If you look at the number of properties brought to auction to foreclosure sale, it drops down to about 50% of pre-pandemic levels. So if you're an investor who's used to going to an auction to buy these properties, you're going to see half as many properties being brought to auction as you saw back in 2019. And then if you're an investor who likes to buy properties once they've been repossessed by the lenders, REO properties, they're running at about 30% of pre-pandemic levels. So it's clear that what's happening is a higher percentage of loans that get that first foreclosure notice are getting resolved one way or the other before they get to the auction. And the sell-through rates at auctions are also higher than they were prior to the pandemic. So of the 50% of the properties that get to auction, about 60% of those are selling at the auction, which leaves the lenders fewer and fewer properties to take back. So what I've been telling investors and real estate agents who play in this space as well is that you have to really look upstream this cycle compared to what you did last time. If you were playing in the distressed space in 2008, 9, 10, 11, you really were better off waiting for the banks to repossess the properties, get a listing or buy it directly from the bank at that point, because that's where the overwhelming majority of properties wound up. If you're in today's market, you need to be reaching out to the homeowner who's in distress when they get that first legal notice. Because the odds are that a lot of those folks are going to wind up selling the house prior to the foreclosure sale. If you're used to working with bank-owned properties, you probably want to be looking at the auctions now, because that you're going to see more of those properties selling there. So it really is a very different market than what we saw the last cycle, and I would not be surprised if this is becoming a structural shift, it not just something going on this cycle, but if in the future we're not going to continue to see fewer properties being repossessed by the lenders and becoming REO assets.
Interesting. So that's a good transition point for something I was looking forward to talking about, which is we have a tremendous imbalance of folks that want to buy single family houses versus single family houses that are available for sale.
Yeah.
Now, there's been some amazing data put out by the home builders on activity of folks signing contracts and closing.
Yeah.
And surprisingly enough, home builders are certainly experiencing a resurgence. That's one side of it. The other side of it is folks that have interest rates that are in the 3s and the 4s and maybe want to move down or up depending on where they are in their life cycle, just can't bring themselves to do it because of that amazing mortgage that they have signed up for over the past few years. I'd love to hear your take on both sides of it, on how this is going to be resolved.
Well, I can give you my view on both sides of it. I'm not sure I can tell you how it's going to. I can tell you how it's going to be resolved. It's going to take time, and ultimately, we need more homes being built. That's not a quick fix. That's not really what anybody wants to hear. But as long as the majority of people prefer to live indoors, this is going to be a bit of an issue. Your insights are absolutely correct. Right now, new home sales account for between 20 and 25% of all residential purchases. Normally, they're between 10 and 15%. This is not necessarily due to the fact that everybody decided they wanted to buy a more expensive home, so let's go shop for a new one. It's because that's the only inventory that's available to purchase right now. Builders, if you look at how new home inventory numbers are reported, there's typically 3 stages that are reported. One is properties that are completed and available for sale. One is the properties that are under construction, and one is properties that haven't been started yet. So permits have been issued, the land maybe is cleared, but construction hasn't started. We just came off an historically low period of inventory of homes completed and available for sale. So for the last few months, that number has been improving. We're back up to more or less normal levels. We're now coming down from the all-time high in the number of homes under construction. And that number was inflated because supply chain disruptions were rampant in the home building market. And this is still a problem, there's a shortage of labor in the construction market. So it's simply taking builders longer to build these homes. We ran into an issue about a year ago when interest rates went up, where the builders were seeing an unusually high percentage of cancellations. Buyers walking away from pretty significant earnest money deposits because they simply couldn't afford to buy the property anymore at current market mortgage rates. The builders have started to address a little bit of this, and this is the other reason we're seeing an increase in new home sales, because they're motivated to sell. If you're Pulte or Toll Brothers or some other major builder, you have properties vacant at the end of a development. They're costing you money every month. You want to sell those off, recapitalize, and move on to your next project. So they're offering incentives, they're offering concessions, they're offering price discounts, they're offering cash to pay points to bring down mortgage rates, and you're seeing all of that going on in the new home market. And so really what's left is the builders working through this current, I'll call it a glut. It's really not a glut, but I can't think of a better word, of homes under construction. As they work their way through that, they're not starting enough new homes to kind of keep selling at that pace. So even though right now the annualized rate of sales is somewhere in the neighborhood of 685,000 new homes, I still believe we're going to wind up ending the year somewhere between 600 and 625,000 all in, just because we're not going to see that many properties come to market. On the other hand, the existing homeowner is not at all motivated to sell. And 70% of those homeowners have a mortgage rate with a 4% interest or lower. And it's difficult for them to rationalize trading in that 4 or 3 or 2.5% mortgage rate for a 6.5 or 7% rate on what's probably going to be a more expensive home. So we're seeing that phenomenon that economists refer to as rate lock, as these current homeowners just aren't incented to sell. And because of that, we're seeing inventory of existing homes for sale actually decline on a year-over-year basis. So we're looking at roughly 3 months supply of homes available for sale. In a normal market, we'd be looking at about a 6-month supply, and that just doesn't seem to be getting any better. Your listeners, your viewers, your borrowers should be careful about what I'll call false positives in some of the headlines about inventory. You will see headlines saying inventory numbers are going up, but you have to read the fine print, because new listings are actually going down, and they're going down significantly on a year-over-year basis. So the only reason you'll occasionally get an inventory number that looks like it's going up is it's sort of like a head fake. It's taking a little longer to sell the properties that are being brought to market, and that's inflating the inventory numbers. So it's not that we're seeing more properties come to market, it's just taking a little longer to sell them, as we talked about earlier, with those days on market going up a bit year over year.
So that begs the question, how do we get interest rates for the conventional GSE loans to come back down to a range where we start to get folks interested in moving? Where does that range look like? And once again, macro, where do you think we're going to get in the hopefully next 2 quarters to get into that range?
Yeah, Jeff, I've been saying all along that I thought the second half of 2023 was going to look a lot better than the first half. I think we probably wind up with a relatively lackluster spring and summer season, which isn't great news for the housing market, because those are usually your 2 prime seasons. But I do believe, and some of the economists that I follow and speak with also believe, that we're likely to see mortgage rates gradually work their way down over the second half of the year. I think that probably would have happened anyway, but I think the issues we're seeing in the banking sector right now are probably going to slow down the Fed's aggressive behavior a little bit more quickly than if they'd been left to their own devices. And I think Fed activity is really what's going to determine how soon and how quickly we start to see mortgage rates come down. I personally don't expect to see the Federal Reserve start reducing Fed funds rates this year. I don't think we'll see that until next year, unless we happen to hit a recession that's a little more severe than most people are forecasting. But I do believe as they stop raising rates, and they've already signaled that they're likely to stand pat in June and see how inflation progresses, that a lot of the pricing we're seeing in the mortgage market today is based on risk and volatility. If you look at pricing of a 30-year fixed rate loan, they've been trading somewhere between 6.25% and 6.6% now for a couple of months, in that pretty narrow band. I think if you look at yields on the 10-year U.S. Treasury, right now they're trading at about 3.5%. And there's usually about 1.5 to 2 points difference between that 10-year Treasury yield and the 30-year fixed rate loan. In today's market, we're looking at 3 points. So it's at least a full point higher than it would normally be. And I think once the volatility slows down, once the Fed signals that it's probably done raising rates for the time being, you'll start to see that gap narrow. And we could see interest rates come down a full point between now and the end of the year. That's my optimistic forecast. I think once we get down to 6% or below, you'll start to see buyers and sellers come back to the market. I think an inflection point, a real inflection point, is probably closer to 5.5%. But when we've seen interest rates get closer to 6% and further away from 7%, we've seen buying activity pop up. So I do think, again, you have this pent-up demand out there. You have people that have probably reset their sights on somewhat less expensive homes than they would have a year ago. And the market does take a little bit of time to adjust when you see interest rates move up and down. But I think, again, once we get below 6, I think the magic number is probably somewhere around 5.5%, where it starts to feel more like a normal housing market.
And to your point, I think in late January of this year, we had that short window when rates dipped. And as I recall, on the owner-occupied side, contracts spiked, even though it was the middle of the winter.
Same thing happened in March, Jeff. When rates started to soften a little bit, you saw buying activity jump up. Now, interestingly, that's probably why we're seeing home prices trickle up a little bit too, because the last thing we really needed was a whole lot more demand given how little inventory there is. And that's why I think it's crucial that the rates come down further, because I think that will incent those currently rate locked homeowners to say, difference between a 4% mortgage and a 5.5% mortgage, I can tolerate that. I can't tolerate the difference between 4 and 6.5 or 7. Or I can't justify it. And so I do think in order for us to get back to a market that's a little more balanced, a little more equilibrium between buyer and seller, we're going to need to see rates come down a little bit further.
And you may or may not know the answer to this, because I've never asked you this question before. Is there a way that we can understand just how much pent-up demand, how much pent-up sales that have not been listed because of this interest rate activity? In other words, is there a way for us to really understand how many folks there is waiting to sell their house because of this and make that move smaller or bigger? Is there a way to know that? And the answer may be no.
There's no definitive answer for that, Jeff, because there are other variables at play. But if you want to use a kind of macro approach to this, we have about half as many homes on the market as we would normally have. I don't think it's unreasonable to attribute most of that to this rate lock phenomenon, because we know there's demand out there. And if you wanted to sell your house, in most markets, you'd have an opportunity to do so. But then, you run the risk of not being able to afford to buy your next house, which is a problem. The reason I don't want to give you a more definitive answer than that is that we'd seen a trend over the last decade where people in homes were staying longer and longer, where the average length of tenure that somebody stayed in a home had gone from 5 to 7 years to 10 to 12 years. And that was primarily the boomers aging in place. And they're continuing to do that. So that also takes some inventory off the market. And then the other factor at play here is we've had, since 2009, we've more than doubled the number of single family rental properties. And these are not largely properties that were built to rent. These were owner occupied homes that have been converted. And that number has gone from about 9 million in 2009 to about 21 million a year ago. So that effectively is keeping, let's say, 10 or 11 million potential homes off the market in terms of inventory as well. So there's a number of these factors that play in, but I have to believe the overwhelming majority of properties that are not on the market today are not on the market because the owners have just decided it's not a good financial decision to sell.
Yeah, that's interesting. About half. That's a real number. That is a number that without interest rates getting back down into the fives, I just don't see it changing.
I see marginal changes, Jeff, but not massive changes.
Yeah.
And the other thing to keep in mind, we talked about new home inventory as well, is some of the builders are diverting their resources to build to rent properties, largely at the behest of large institutional investors who, and I don't know why they didn't do this earlier. I mean, for an institutional investor, build to rent to me seems like a much better strategy than competing for, the scarce inventory against not only other big investors, but smaller investors and traditional home buyers, and doing it one at a time. The build to rent model gives them much more certainty in terms of the quality of the properties that they're going to be renting out, of the price they're going to be paying for the properties, and so forth and so on, and generally gives them a better geographic concentration of those properties. Now, the good news for the majority of real estate investors is this should mean those institutional investors won't be as big a competitor in the coming year as they might have otherwise been. If they're focusing more of their resources on build to rent, that means they'll have theoretically less money to spend on these purchases. But the flip side of that, and where I started before I went off on a tangent, is the builders may not be building as many homes available for purchase because they're dedicating more of their resources to these build to rent initiatives as well. So a little bit of a double-edged sword there.
So good segue to talk about inflation in the building products and what our friends in the new construction business are feeling today. Certainly it was a hot topic in 2022. Sheetrock doubled, lumber tripled. Where are you today, and what do you see coming down the road here?
It's been a rough couple of years to be in the housing market, especially as a builder. There are some good signs. Lumber has come down significantly and done so in consecutive quarters. A lot of other material costs have flattened out, so we're at least not seeing double-digit inflation on that stuff. As supply chains have reopened, we've seen a little bit less of a scarcity model in terms of pricing, so those prices are normalizing. The challenge for builders right now is they were building $350,000, $400,000, $450,000, $500,000 houses, and the people who wanted to buy those houses have had their buying power cut in half because of interest rates going up. So, if you're a builder, you have that choice. Do I keep building a $500,000 house and then discounting it to get rid of it? Or do I try and build a slightly less expensive house? And how do I do that with materials costs not going down, with land costs certainly not going down, and with labor prices probably going up? So it's a bit of a challenge. And I know there's a variety of strategies the builders are trying to deploy to make those numbers work. But it's as we started, that's by saying it's a challenging time to be a builder in today's market.
Is land banking still a thing? Are large contractors still out there aggregating land for what's to come down the road? Or are they just unwinding what they currently own without an eye to the future?
Yeah, I haven't looked at the numbers recently, Jeff, but anecdotally, it appears that land banking is more opportunistic now than more of a long-term strategy. And then there's just some markets where it's almost impossible to do that, and particularly some of the more expensive markets where you just don't want to take that kind of speculative risk. But it seems like one of the biggest issues facing builders is lack of available, plots, lack of available land. So I think there are probably some who would be banking land today if they could, but they can't find it to bank. At least not in any markets where they really want to be building or expect future trends to justify building in those markets.
Interesting.
The other thing you have to keep in mind is migration patterns have shifted a bit. And I, if I were looking to bank land as a futures play, I'd have to be looking really carefully at those tendencies. California lost 300,000 people last year on a net basis. New York and Illinois lost over 100,000 each. You saw, major metro areas on the coasts shedding population. And a lot of it went to the southeastern states, the southern states. So where you buy land as a future hedge is also something you have to look at in terms of where population growth is occurring, particularly migratory population growth, and where job growth is occurring, because those are the two criteria you want to look at to kind of underscore what's likely to be a healthy housing market, both from an owner-occupied standpoint and from a rental property standpoint.
How do we think about immigration from outside the country into the country and how that plays into the housing needs of what we're going to be looking at in the coming years?
Yeah, that's the third rail, isn't it, in U.S. politics, is immigration. Candidly, there's a shortage of workers in the country. We probably need more immigrants coming in. To your point, Jeff, I'm not sure where they live once they get here. Now and then you have to kind of tier the immigrant levels that you're bringing in. If somebody's coming in with an H-1B visa to a high-paying technology job, they'll probably be able to afford to buy a property or rent a high rent property. If you're talking about folks applying for asylum or crossing the border, who are basically coming in with the shirts on their back, they need low-cost, affordable housing, and we're at a critical shortage of affordable housing, both on the rental side and the owner-occupied side across the country. So it's really a dicey situation. We need more immigrants coming in because we have labor shortages, but we also have housing shortages, particularly acute when it comes to affordable housing. So it's almost like those two things are working at cross purposes.
So we're just about out of time. Why don't we try and wrap up here with some of your thoughts on where investors today should be thinking about best, we'll call them actions to set themselves up for success going into the third and fourth quarter of this year. What are some of the plays that you think investors should be making today to set themselves up for success in the second half of this year?
Great question. I think if we're looking at the second half of this year, and if I'm right and interest rates start to come down, you should be doing your homework today, identifying not just markets, but submarkets, kind of micro markets, where you think population growth and job growth are going to be driving a healthier housing market. And again, those two criteria tend to be the foundation of strong owner-occupied markets and strong rental markets. The other thing you probably want to be asking yourself as an investor right now is if you believe the market's recovering enough for you to make the kind of profit you need on a fix and flip. Or if, at least in a short-term basis, maybe you're better off in your markets looking at buying a property, fixing it up and renting it before ultimately flipping it, a few years down the road when market conditions improve. So that's something I've been talking to investors about as well, is, you know, what your model is during this period of time. And I guess the third thing I'd be saying is, you know, to look for win-win scenarios with those borrowers who are financially distressed. Having 75% equity in your home doesn't prevent you from going into foreclosure. That's due to a job loss, income loss, death in the family, divorce, unexpected medical or repair bills. And there's opportunities if you reach out to those homeowners early on to create a win-win scenario where you get a property below market value, but they still make enough money selling you the property to pay off their bills and start with cash in their pocket. And in some cases, those folks are very good rental risks. So if you wanted to buy a property and rent it back to the original homeowner, you have a built-in tenant. You don't even have to do a lot of repair work to the house. So I think those are things, Jeff, I would be looking at is, you know, looking at your local market conditions, maybe looking for different markets than where you're located, based on those criteria we talked about: population growth, job growth. Take a look at distressed inventory opportunities, but further upstream, and then take a look at your business model to make sure that you're in the right model for this point in time and in your particular markets.
Rick, appreciate all your time. Thanks so much for all the insights.
My pleasure, Jeff.